Hello, this is Bob Steele. In this lecture, we will take a look at Chapter H, which deals with variable costing and the cost of quality and sustainability. Learning Objective 1, explain the accounting treatment of fixed manufacturing overhead under absorption and variable costing. So we're going to look at two costing methods. We've traditionally been looking at absorption costing. We're going to then take a look at the alternative being variable costing. So we've talked a bit in the past about the difference between the cost behavior between fixed costs and variable costs. And there's some pros and cons to the absorption versus the variable costing with relation to these costs because of the behavior of them. And what we're going to be looking at for the most part is overhead. So overhead oftentimes has a variable portion and a fixed portion to it. And traditionally what we've been doing is we've been allocating in some fashion all of overhead into the cost, and we've been taking a look at it under an absorption cost method. And under the variable cost method, we would then treat part of that cost, being the fixed cost, as a period cost rather than being included in the production cost and being expensed as cost of goods sold. So let's go through this process and talk more about what we mean here. So first, let's take a look at the absorption costing method. So a system of accounting for costs in which both fixed and variable production costs are considered product costs. So remember, if we talk about direct labor and materials are of course going to be in the production cost, meaning they're going to go into inventory and they're going to be then expensed as cost of goods sold once we sell the product. The questionable one is always this overhead one, where we've been putting all the other stuff, so that we could have the depreciation on the factory, we could have the insurance on the factory, we could have the salary of supervisors on the factory, we could be talking about small things, products or materials such as oil or wood or any kind of glue, nails and stuff like that we're going to put into this one big overhead pile. Now there's two things that are in that overhead pile. Consists of different types of overhead. Fixed overhead, stuff that is going to be the same cost no matter how many units produced, and variable cost types of overhead. And what we've been doing up to this point is taking all of those, because they're all considered part of the product even though the cost behavior is different, and we've been putting all variable costs and all the fixed costs that relate to the production into the product. So that's great. It does kind of distort the cost when we produce at different production levels, so our estimates could be different. So that's going to be our traditional method that we've had. Now the alternative to that would be a variable costing system, a system of cost accounting that only assigns the variable cost of production to the product. So in this case, we're going to take that overhead, it's generally the overhead that would have fixed costs in it. We're going to eliminate those fixed costs because of that difference between the cost behavior. We're going to treat those fixed costs as a period cost, just like we do with selling and admin. And then we're going to treat the variable costs as costs that are in production. And therefore, it's a lot easier for us to think of different, volume levels of production and use those variable costs, and it will be more accurate in that way to have different volume levels and think about things in that context. So in some ways, this way could be a preferred way to look at it for some ways. Okay, so then the difference between the absorption and variable costing. Absorption is going to be up here. You notice what we have is we have direct materials, we have direct labor, and then we're going to break out the overhead between the variable portion, the stuff that changes with each level of production, and the fixed portion. Under the traditional method, we basically put those together and we put it all in to the cost of production, so the product cost, and the period cost, all we had was the selling and admin. Under the variable cost, the new system, what we would say is that we're still going to have direct materials, direct labor. We're still going to have the variable portion of overhead, the stuff that changes from as production level changes. But the fixed portion, we're going to include that down here on the income statement. We're going to expense that when it is incurred rather than when we sell the product in this method. So the difference between the absorption and variable costing is the treatment of fixed manufacturing overhead. Learning objective number 2, prepare an income statement under the absorption costing. So let's take a look at this. Let's put some numbers to an example and see what we can learn about the difference between absorption and variable costing. So absorption and variable costing. So we have this information here. We have the number of units produced annually, 25,000 units. We have variable costs. So we have direct materials, direct labor, and variable manufacturing overhead. These are all the variable stuff. Selling and administrative expenses are going to be here. We have the fixed costs per unit. We have the manufacturing overhead here. So these are the stuff that's going to be, not change per unit of production. And we have the selling and administrative fixed portion of that. Then if we take a look at the absorption and variable costing, we're going to look at the unit product cost is determined as follows. So under the absorption, we're talking about the unit product cost. So how much does it cost per unit to produce per unit? We have direct materials, direct labor, and variable manufacturing overhead. So we've got the 10 and the 10 for both absorption and variable. The fixed cost, on the other hand, notice what we have to do to the fixed cost. We have to take the 150,000 divided by the units. So that's kind of an estimate if this is a projection, because we don't really know the number of units, and the cost allocation will differ as we produce more or less. So that's the distortion that can happen. Under the absorption method, we're going to do our best we can and put that number here and say it's cost us $6 per unit under the absorption method. Under the variable costing method, we're going to say we're not going to include that in the cost per unit. What we're going to do is say that's a period cost. So, and we know that on the selling side, even though that I believe we had selling and administrative that was both variable and fixed, we're not going to include any selling and administrative in the cost of the stuff we produce, because selling and administrative is not part of the inventory that we will then sell. So selling and administrative expenses are always treated as period cost and deducted from revenue. So if we go through our statement here, we know that we had the beginning inventory produced 25,000 units and sold 20,000 units this year at $30 per unit. So 20,000 times 30, that gives us our 600. Then we're going to take the cost of goods sold minus the cost of goods sold. Biggest number on the income statement, our largest expense, the cost of the inventory that we sold. So we produced 600,000 selling stuff. And then we're going to take the 25,000 times the 16. That's our beginning number. And then we added the 25,000 times the 16 gives us the 400. That gives us the cost available, the 0 plus the 4. Ending inventory, 5,000 units left, times the 16 cost per unit that we calculated in the prior slide under the absorption method. The 400 minus the 80 gives us the 320. So then we're going to have our subtotal of gross margin. So that's what we sold it for minus the cost of the stuff that we sold, and that gives us the 280. Then we're going to have everything else, which is in this case is period costs of selling and admin. So everything else is selling and admin. We had a variable portion, we had a fixed portion, adds up to 160. The 280 minus the 160 gives us the 120 profit. Next time we'll take a look at the variable method.